I do like to start off the show each week with a summary of kind of what's happening in the markets overall for the last week. And um, pretty good time to talk about this. I mean, today is triple witching day, right, with the options expirations and those types of things. So the market was down a little bit as the show started here. But yesterday was a really big day, up 1.7%. And more importantly, it broke through to a new all-time high.
Yeah, it finally broke that resistance level.
Yeah, and you can see, this chart goes back, to 2018 timeframe, and you can see what's been going on and the nice run we've been on here. However, if I bring this in, a little bit closer, so just year to date, this is a daily data. And so you can see, had a nice run and then about a 5% drop there in April, and then a really good run out of that up until the 16th of July. That was our all-time high for quite a while, and then a pretty good size drop. That's an 8.5% drop in August, and an unbelievable recovery, right? And then another big drop the first week of September this month, and another recovery. Kind of amazing. And we're still, setting higher lows all the way through, even in this time frame. But what's important here is I put a couple of lines there to emphasize this. I really like what's happened this year at the moment in terms of this kind of consolidation that we've got, right? We just spent 8 weeks going sideways. Lots of ups and downs in there, but essentially going sideways. And what happens is it means that there's a lot of shares accumulated at the pricing that's in that range. And so if the market jumps above, which it has done, and starts to come back down, and actually you can see that in today's data, it's down near the top, it's kind of hitting that support level. It becomes support because somebody says, hey, I bought it at this and it went up. If it gets back there again, I would buy some more because I was successful last time. That's the theory behind support. I think it's important to go sideways for a while, just for the stance of we've had such a big run. I mean, as of yesterday, we were up over 20% for the year, which is a really good year. Last year, we were up over 20% also. So, we've got a lot of stretching going on here. So having it go sideways for a while, it allows the pricing to get less out of control, earnings to start to catch up to the pricing, and it provides this support level. So this is a really big deal. We'll see if we keep it. I wouldn't pay too much attention about what happens today. In my, time frame of watching the markets, it seems like most of the times a triple witching day, the market is down that day. There's a lot of, it's sort of a temporary thing. It happens once a month. So it's not something I would hang my hat on. I wouldn't worry about what's going to happen today per se. I think more interesting to see what's going to happen next week. The market dropped when they announced the 0.5 point rate cut that day on Wednesday. And this was a big deal because the betting in the futures market was more weighted towards a 0.25 point rate cut, and they ended up doing a 0.5 point rate cut. And so at first, in my opinion, I even said that the day before, everybody's expecting the market to go skyrocketing on a rate cut, and they're all on one side of the trade. And often when that happens, you end up going the other way. There's just nobody else, on the other side, and so it's pretty easy for them to make an impact. And that's sort of an ongoing theme, actually. When everybody is talking about something, it rarely happens that way. With the market, the market, generally will respond better to things that, or worse, to things that we're not talking about, right? And so, very important though, they started the rate cut regime off here. Again, we presented last week that at the last 11 rate cuts within 12 months, 9 of those time frames were up versus down, and up an average of 14%, right? So it's 82% or something like that for the last rate cuts. And it really just comes down to, why are they doing a rate cut? Are we having a rate cut because we have softness that's coming into the economy at a pretty high rate, and now the Fed is really just behind, and so we're going to end up in a big recession? So because the 2 times out of those 11 when the market didn't make money was in 2000 and 2008 timeframe, those 2 big downturns. And so you'd had massive numbers of increase of rates by the Federal Reserve in those timeframes. and the economy really just fell apart in both time frames. So that's going to be the thing that everybody's looking at here. Inflation probably going to be less talked about. The election's going to be a really big focus here in the short term. But I still think that the recession, fear of recession, and that's if you look at like even the beginning of this month in September, we had a big drop. We dropped. It was only a 4-day week, because of the holiday, and it dropped every day, mainly because we were getting numbers about the jobs market being softer, right? And the Federal Reserve has a dual mandate: have full employment, which they consider roughly around 4% unemployment, which is interesting, or better, right?
Yep.
And then a 2% inflation rate, looking at core PCE as the measure. And so we're at 2.6% on PCE. We've kind of flatlined the last 3 months on that. But the labor market has got soft. The number of job openings has come down some. The number of first-time unemployment claims this week actually did quite well, which is kind of interesting. But it had been doing not as well. Matter of fact, this week is the best first-time unemployment claims that we've had since May. So, not that far back, but nonetheless, partly why we saw the market move so much yesterday was because that's the soft landing. That's the whole thing where you end up with the economy that does okay in an environment where they had to raise rates pretty dramatically in order to fight inflation. Inflation comes back down. I mean, we're not through this yet. We've got, talk to me in 2026 or something when we can really see the impacts of all these things. But so far, we're kind of threading the needle. It's been amazing. Yeah. I mean, there hasn't been anything like this in my 37 years, that's for sure, where you had, a situation where they raised rates, from 0 to basically 5.25 very quickly, and we didn't have a recession. And you're going to have a recession in every other environment that I've ever been involved with. And Wall Street, at least last year especially, was really caught flat-footed. They were expecting recession last year to really kick in because that's what happens. But what you have here is that pandemic and that pent-up demand and all the money that the government had pushed out, to try to support the economies of the world, not just our government, but all the governments. And that money's just kind of sloshing around. And then you had a lot of people, they want to get out and travel, want to go out and do all these things that they couldn't do for a little while. So it ended up being an offsetting kind of teeter-totter scenario where things kind of evened out. And we still have economic growth, even though, we've have this higher interest rate picture. So I think it's kind of fascinating how this has played out. I still think there's a lot of room to run for the market. Again, we are in this weird time frame before the election where, at least for the last 5 presidential elections, when we showed that on the chart, on the last show, it's been negative for that 60 days before, right? I wouldn't be surprised to see this thing struggle. However, we did break up into this new high, and so it's kind of interesting to see how that plays out. It hasn't broken up that much. Can it fall back in there? Sure. It's not a one-day thing. It's more of a longer thing. A couple weeks. If we can stay above, then we're probably going to keep going. But again, I wouldn't be concerned about this type of activity that's happening here. This is just a kind of the market's waiting to see what happens with the election. The market is, okay. There's nothing really wrong with the economy, the jobs, the earnings. Yes, things are slowing down some, but they were too hot in the first place, and that was what's causing some of the inflation. So, as long as it doesn't slow down to the point where we end up with a recession, and that's what we watch for. I don't see that yet. I wouldn't be surprised to see a recession, but it's just the indicators are flashing red in the sense of, the traditional inverted yield curve, those types of things. But man, those things inverted, a year and a half ago or more?
They're finally positive now.
Yeah, now they've, back into normal curve, the inflation rates, the interest rates on treasuries. And so, those things didn't pan out. The leading economic indicator, which has an incredible track record, went negative. And we have not had a recession. Now, maybe it's just early, like really early, like a record early for those indicators. Or maybe those indicators we look back till, 1970. We look back to World War II. What we are not looking back to, not really capable of looking back to, is the last time we had a pandemic.
Yeah, that was 1918.
1918. And so, things have changed too much anyway. There was no S&P 500, there was no NASDAQ, there was no Russell 2000, there was just the Dow, right? There was 90% actually in that time frame. They had 90% margin, and that's what, part of led to the run up of the
Roaring 20s.
yeah, the Roaring Twenties and eventually the Great Depression. So, the time frames are too different as far as that goes. So now you throw in artificial intelligence, you throw in some good earnings from companies, pretty solid earnings again. You end up with a market that's doing pretty well. So here's where we are now. We just had a trend change on the hourly back to green yesterday. So again, we're just tracking the primary trend of each one of these hourly, daily, weekly, and monthly. And we had it go red in July at that peak, had it go red in September at that peak, right? And it's back to green as of yesterday. So that's, every trend piece, daily, weekly, monthly, and hourly are all green now. And then we look at market breadth. This is a much slower moving piece. We're just trying to see. This hasn't actually changed since June 3rd. And just looking at these different broad market, ETFs and some sector ETFs that are representative of the markets, the economy, maybe more like semiconductors and utilities and transportation. The only one that's red is transportation, and that's actually pretty close to breaking out to green. We'll see. Might not do it, but it's getting there. So anyway, that's overall the market is fairly healthy as far as that goes. There's no issues. Yeah, like I say, we've gone sideways for a while. I think that's a good thing here in the short term. And then we talked about this last time where we're seeing this rotation in our ETF list of things that are moving quite well and where the money's coming. And so we had gone from, in our targets, we have a majority of our money outside of targets. And here's something I recommend to think about this. We are seeing a lot of rotation right now. And the best way to fight that rotation is to make sure that you have a lot of your money in things that cover almost everything, like the S&P 500 or the Vanguard Total Stock Market Index, which covers almost every stock. That way, as it rotates around, you're not having to chase that and underperforming. We use this little slice of what we call our targets to try to outperform the market with this piece. It works, overall, but periods of time it doesn't work, But what was interesting was real estate, healthcare, financials, consumer staples, and minimum volatility. The market was moving into a safer area.
Yeah,
or
low
at least,
volatility.
Yeah, the money was coming into that area. And as of today, actually, we sold healthcare, we sold staples, two defensive categories, and bought Focus Value, which is a iShares ETF, and we bought cloud computing. And so we've had that cloud computing in the portfolio a few times. So you can see there's a little bit of a shift going on. And again, very difficult to keep up with that shift as far as we're concerned. I just find it kind of fascinating to see what is moving more than anything. And make sure you have, in this environment, there has not been a solid run in any particular category for a while. We had a really solid run in the big tech for quite a while, right? For over a year. You could launch into that and just continue to outperform the market. And now we're in this choppy seas where things are moving and rotating. So it reminds me a little bit of 2021. The rotations don't last that long. It's hard to get on and have it really work out. So make sure you've got a majority of your money in the overall broad indexes, especially in this market, and then wait for the run. It'll come. Something will pop up and really take off. And, right now the money's just trying to figure out where it should go. And there's new things like, hey, they just cut rates 0.5% instead of 0.25%, right? And that's what's kind of fascinating here. Now, this is the CME Fed Watch, Market Watch tool. And this is the futures market. And again, this is hard to see, but I'll just give you the overall concept here. Right now, for the next meeting, which is November 7th, okay, so right after the election, so they don't have to worry about politics, and they didn't worry about it anyway. They did a 0.5-point rate cut right before the election. So, and right now, it's a 50-50 bet between a 1/4-point cut, additional quarter, or an additional 0.5 point.
Yeah.
There is 0% that we're going to stay the same. That's
because the Fed even announced that they expect that by the end of the year they'd cut 1%.
Yeah, exactly. And that's what the market had said before, the meeting too. So Market and the Fed are starting to line up a little bit better. They've been kind of disconnected for most of this year.
Yeah.
That's for sure. So I think that'll be kind of interesting. Another half a point. I'd be surprised, but I was surprised by this one. So who knows? And there's a lot of commentary about, well, is this, an issue where the Fed sees something that we don't? Is the economy actually weaker? The Fed has 400 economists on staff. I think they all have to have a PhD, the whole thing. And they still, unfortunately, get this wrong almost every time, which is kind of incredible. They over-raise rates or they don't raise them fast enough because it just shows you how difficult it is to do what they're doing. But it is fascinating to see because the market itself is a very fine-tuned, gauge. This is where people are putting their money, right? Matter of fact, I just saw a thing the other day where there's a data scientist that works on who's going to win the presidency based on the betting pools and not based on polls. And his thought process is probably pretty sound, and he was right in 2020. And it's just that the money, you're having to put your money up. You're not just answering a question who you're going to vote for. You can say whatever you want. People are putting up their money and making bets, and so that's what we look at here. Is the people are putting up their money, making bets, and and once you get into that level, you end up with this machine that gathers information known as the market. Basically.
Yeah, it's kind of like you're crowdsourcing everybody together.
Yeah, and it's amazing. And it's why the S&P 500 is a machine, right? The whole thing, the whole mechanism that goes around that. And it's one of the main predictors of future economic performance is the S&P 500. And again, we just set an all-time high yesterday. I'm telling you, the market is saying the economy is still going to be okay for the next 3 to 6 months, right? And you'll start to see true, breaking of the, primary trend and get into a primary trend down. That's a sign that we might be seeing problems in the next 3 to 6 months. Again, the market leads. It's not. It reacts. I'd say it's like 75% leads and 25% reacts to what's happened today, right? I mean, that's kind of so. Mainly, it's leading. And so what you're trying to do if you're trying to get ahead of the market is you're trying to guess where things are going to go. I tend to just look at the market and say, okay, where are things going to go? And then just kind of get in there. And you're later, but you're often more accurate than trying to guess. If you guess right where things are going to be, you make more money.
Yeah, it's like you take a single versus a home run, right?
Yes, right.
You're going to strike out a lot more when you're going for home runs than when you go for a single.
Yeah, and it's something we talk about all the time, the concept of predictive investing versus reactive investing, right? So predictive, saying, I'm predicting that this is going to happen, and I'm going to buy these stocks or this portion of the market because if that prediction is correct, that's going to be the recipient and it's going to win, whether it's anything, right?
Yeah.
Versus, hey, the market is moving over here. That's telling me something. I mean, cloud computing's just taking off, focused value is taking off, real estate's still hanging in there, And so let's ride those things and let's keep going with those until that, peters out and then what else is coming. And so that's reactive. It's two different things. It's, most of what you read about is predictive because it's cool. It sounds interesting. It gets a lot of clicks. Somebody's going to tell you. I mean, Jim Cramer, he just predicts stuff constantly on his show, right? Now, I just read an article where he said, just touted, I think 24 hours ago or something, FedEx dropped like 10%. Long term, it's probably a great company. Lots of things going through the mail now, but not today. Or not yesterday. So anyway, that's our summary for the week. Really, market's doing quite well. I'm very excited that it broke out. Don't be surprised if it doesn't stay up. This is a weird time of the year. But you got to get past today. Just ignore today. Let's see what happens next week and see if we can.
Yeah, it'll be interesting with rebalancing too. At the end of the quarter.
Yes. Yeah, that's right. So that's a big one actually, because we've often seen a drop right at the end of the quarter because of the rebalancing. So it'll be interesting though, because bonds have done pretty well here in the third quarter on a relative basis. So maybe we're selling some bonds and buying some stocks this time. It's been a while since that's happened. So we'll see. But it is something to know about and be aware of. If you start to see really weird activity, the last few days of a quarter, it's sort of like today. You can kind of ignore it and wait and see what happens once the quarter's over. So, all right, good. Thank you for joining us for this portion. Again, I always like to do a summary here at the beginning, and we'll do another one next week. But